Welcome to the Ottawa Business Journal's live broadcast of Don't Risk a Potential M&A Deal, a legal roadmap for success. I'm Michael Curran from the Ottawa Business Journal. Thank you for joining us today. Today's topic was shaped by recent discussions with local business owners and entrepreneurs. These business leaders told me they are frequently receiving unsolicited emails and phone calls about buying or selling their business. Now, you might think, oh, this is very Bay Street, the highfalutin world of corporate M&A. Not so much. That's not what we're talking about here. We're talking about local businesses, healthcare practitioners, home services like plumbing, electrical, heating, air conditioning, service businesses, and real estate brokerages. Here's the key point. If you're a local business owner or entrepreneur these days, you need to have a basic understanding of the world of mergers and acquisitions. If you don't, you could risk a successful exit from your business or an acquisition opportunity. In today's live broadcast, we will walk you through several key points. We're going to spend a lot of time on the legal roadmap for M&A, so you get a sense of it. We'll talk about how deals are typically structured, and we'll wrap up after our Q&A session with what pitfalls to avoid. To explore today's topic, we've enlisted the help of Nelligan Law. More specifically, we're talking to two of its great professionals. Please welcome them now. Here is Audrey DeMarsico and Jacob Harper. Hello, Audrey. Hello,
Hi.
Jacob.
Hi.
How
Thanks
are
for
you
having
guys
me.
doing today?
Great, thank you. It's
Yeah.
great to be here.
Thank you. Thank you. Appreciate that.
Thanks for having us, Michael.
Yeah, it's awesome. We got a good topic here. I'm going to give today's audience a little bit of a preview of today's show. In our first topic, as mentioned, we're going to talk about the legal roadmap for M&A, and we'll probably spend a good 10 minutes or so on that. In topic number 2, we'll talk about the deal structure. Then sometime around 12:25, 12:30, we'll have our live Q&A with our audience. If you're on and listening live, a reminder that whether you're on YouTube or LinkedIn, you can type your comments in and we'll be moderating them towards the end of the show. And we're going to end up with some pitfalls to avoid. So without further ado, we're going to start with our legal roadmap for M&A. And again, we'll spend a lot of time on this one. Audrey, I think you're going to start things up. So let's talk about how sellers can prep, and we'll bring up our visual aids, as they say.
Great. So yeah, sellers can prep by making their business look as attractive as possible. Now, one thing that involves making sure that all your corporate records are up to date. So you'll want to consult with a lawyer. If you're planning to sell your business or even just thinking about putting it on the market, you want to make sure everything's squeaky clean. So you'll want to consult with a lawyer to get all those corporate records up to date, make sure everything that you're doing is properly authorized. You'll want to consult with your accountants, get all your financial records and tax filings up to date, make sure that any relationships your business has are properly papered, so the value is reflected in the legal documentation, and you're going to want to make sure that you're presenting it in the best possible light. So you might need to, it depends if you have already an inquiry, like Michael mentioned, where somebody's already contacted you with a serious offer, then that's one starting point. But if you're just thinking about selling it because you're ready to retire, for example, or to move on to greener pastures, then you might want to put together a whole information memorandum, or we can also call it an offering memorandum. That's like basically a little cheat sheet that can tell potential buyers what you have to offer. And then you'd usually have a non-disclosure agreement to go with that, so that whatever it is that a potential buyer learns about you when they say they're interested isn't something they can then use against you.
Okay, over to our next slide. And Jacob, you're going to take the lead on this one. And it's kind of the flip side of the coin, if I can put it that way.
Yeah, thank you, Michael. So from the buyer side is pretty self-explanatory. Is you're looking to develop a strategy of why you're acquiring the company and what are you expecting to gain from purchasing the company. Is there a specific reason, such as the business would give you access to new markets that are available? Would this help you expand your product lines and diversify what you sell from your business? Or is it going to increase something like your brand recognition? Further, buyers will want to develop an idea of what's the criteria that you're looking for in a potential business, such as, is it a new geographical location that they have the market cornered on, or do they have a strong customer base or customer list, which would help grow your sales in your business. And finally, is from the financial reporting, is there generous profit margins that you're looking to obtain to ultimately gain more money for your potential business?
Audrey, we'll come back to you. I think one of the big issues, whether you're on the buy side or sell side, is valuation. So give us a little bit of information about how you might think about determining business value.
You're absolutely right. That's a very important point, and it can be subject to tense negotiation. Of course, buying or selling a business is really about the value for a lot of people involved in the transactions, it can be something that can involve a lot of negotiation, but it really helps to get professional advice. So there are people called certified valuation specialists, appraisers. There's all kinds of accountants that can be helpful. And they have different methodologies that they can use. So for example, they can look at, well, what's the value of the assets that the business owns? What's the value of it as a going concern in terms of, what's the cash flow coming in and going out? They can do market comparisons, do other similar businesses, see what those have been going for. And they can look at just what income is coming into the business. So these are definitely things that buyers and sellers are going to want to negotiate, and you're going to want to have input from professionals for the process.
Okay. And Jacob, there's a lot of key terms when I'm thinking of this. And one of them I've seen over the years is LOI, which stands for letter of intent. So tell us what that means, Jacob, and why that might be important if someone's considering either a sell or a purchase.
Sure. Well, so a letter of intent is it's a very important document for this starting the process of mergers and acquisitions, because this is when the buyers and sellers, they start getting serious about a deal. They enter a letter of intent, which is really a preliminary agreement or an agreement to come up with an agreement subject to certain conditions of the proposed deal. The main importance of a letter of intent is really what you're trying to do is you're trying to lock in the buyer or seller into exclusivity of negotiation. You want to make sure is that while you're negotiating the deal, they're not turning around and going to another party to try to negotiate a different deal. So one of the key clauses that is typically in a letter of intent is that you have the exclusive negotiating right to purchase the business. The second one will be is if there is no non-disclosure agreement signed, typically binding provisions of a letter of intent will be non-disclosure of any information that the selling corporation provides to the buyer corporation. Other typical terms that can be included in these agreements are sometimes you'll see a proposed purchase price or a formula for calculating the purchase price, timelines for when the deal is to close, such as how long, say, a due diligence period will be, how long for exchange of documents, and how long to negotiate the final agreement. Thirdly, if there's employees that are a key portion of the deal, employment law considerations will usually be in the letter of intent, such as if employees are intended to transfer or only key employees are being retained. And then finally, there's Investment Canada Act considerations is whether it's a Canadian investor that's buying or a foreign entity, or if it's a very large corporation, if it's going to trigger any, as Americans would call, antitrust considerations or Competition Act considerations here in Canada.
I like that, Jacob. The LOI is an agreement to enter into an agreement. When I hear that, it just emphasizes that this is a very step by step process, and the LOI, of course, can be, that really important first step to set the terms of how we're going to, what this process is going to look like, and some of the key terms. Audrey, we'll go back to you. When I think of this and think of business owners that have gone through a sale or purchase, the part that they really, I guess, complain about is this concept of due diligence. because it can be somewhat excruciating, but it's excruciating for good reason because it is kind of the exploratory aspect of this. But anyway, Audrey, tell us a little bit more about due diligence and why it's important.
That's right. So it's something that's there really for the benefit of the purchaser. So yes, it could be painful for the seller, but the idea is that before you commit, before you actually hand over the money, you want to look under the hood. You want to see what's actually going on in this business. And that is the exact reason for all the preparation that we talked about at the beginning. It's because once you have signed that letter of intent and you're saying, okay, we're serious about entering into this discussion about a transaction right now, and you have your non-disclosure agreement in place, that's when the seller has to open everything up, hand over all those legal records that I mentioned that you need to have up to date, all those financial records, all those contracts that make your business valuable because you have contracts with, say, key customers, key suppliers, key employees, all those things that make your business valuable. I mean, the seller doesn't really know until they can see them on paper, the contracts for them, if they're really getting the same value that the seller listed in the term sheet. So yeah, it's important. Usually there's going to be like an electronic data room where the parties will upload things. And so say you're doing a straightforward share purchase, which we'll discuss later, then you'd have a data room where the seller will upload all those corporate records in one folder, all those financial records in one folder. They'd give links to that data room to, say, the other party's lawyers, the other party's accountants, the other parties themselves, so they can see everything that makes this business valuable. But the buyer doesn't always just go by what the seller's uploaded. It can also do its own research. So it can search court records, and it's easy for lawyers to do this at the click of a button. You search the court records, you search the bankruptcy records, you search the what we call property security registration. So you know if a lender has a lien on their property and what the priority is of the lender. And so you can run all kinds of, or your lawyers can run all kinds of searches. Your accountants can run searches with the CRA and figure out, like, what does this company owe? What value does it really have?
Yeah, like it's such a good point, and this is going to sound a little bit dubious when you're looking for skeletons in the closet, right? Because you have a perception of this business that you're going to buy, but you really do want to check things out as much as possible. And from what I've heard, there's often a lot of, maybe not always the case, Audrey, but a lot of back and forth in the due diligence. So as you indicated, it's not just the supplying of, here's my balance sheet, and here's my income statement, and here's my letters of incorporation. There's going to be a lot of questions like, whoa, on the balance sheet, what does that mean? Or the income statement, or why is there discrepancy in your your bank account statement versus something we're seeing, or maybe even intellectual property or problems with employment law. So this is the key component, right? And that's why it can be so excruciating, because if you're a buyer, you really do want to go checking for the skeletons in the closet. Not saying they always find them. And Jacob, I think we're going to talk about post-closing, negotiating and closing the deal. So you do your due diligence, and now it's ready to, I guess, do those final negotiations. Jacob, tell me more about what you think that looks like.
Yeah, so you're exactly right, Michael. So basically, after you've done the due diligence process, buyers will meet with their team of advisors, and they'll decide whether they want to move forward or not proceed with the transaction. So if they give the green light to go ahead in negotiating and closing the deal, they'll work out the finer details of the transaction, such as certain conditions that they have, like say they find certain things that may be a concern in the due diligence. So they want, say, a condition that, say, a shareholder loan is paid out because there's loans outstanding to shareholder. They don't want to take those on. Seller, please pay those out before we agree to take on the business. Of course, more importantly, also what the final purchase price for the business will be. And the letter of intent might lay this out, but at the same time, the letter of intent is typically non-binding on that subject. So final negotiations around purchase price, and more importantly, how that is paid, is negotiated. There are certain ways that this can be done. Not always do businesses have cash up front to pay the whole purchase price. So you may typically see either financing come into play, either from a bank or another business, or something that's known as an earnout, certain such as payments being made based on certain performances of the corporation after it's bought. Other things that get negotiated are the representation warranties and indemnities, which would relate to why the parties are entering into the transaction. Once that's all decided and sort of the final purchase agreement is signed up, of course this is where the lawyer's role really comes in, is that we're charged with actually finalizing and closing the deal, to making sure that all the financing is secured and is obtained from the financial institution, should it be necessary. And if there are any third-party approvals, such as if there's licenses from a government organization or another party to operate, is the buyer going to have the necessary things in place to operate the business? With this, a bunch of closing documentation is drafted, signed, and exchanged between the parties, and of course, most importantly, receiving the funds for payment of the business.
Yeah, Jacob, when I touch on one thing you talked about, which is the earnout. Um, it when it comes to these sensitive issues like this, again, I've talked to people that have been through a sale and they have an earnout clause. So as you indicated, an earnout clause would be, potentially the total amount paid for the company is going to vary somewhat based on its financial performance, let's say 6 or 12 months or longer afterwards. When I think of issues like this, it just underlines why you need professionals at the table, whether it's your accountant or your lawyer. Because if this is your first time going through a purchase or a sale, like, you're not going to have a concept of what happens with earnouts and the pros and cons, and how, for example, I'll just use this instance of, a price might be promised, but if there's an earnout, the price that was promised on the initial paperwork at closing might be very different based on future financial payment. So I guess, Jacob, I'm not really looking for you to comment, except to say this is why you need professionals, like, effectively guiding you through this process, right?
Yeah, you're exactly right. And it's just that having a good team of professionals is always recommended by anybody sort of involved in the M&A world. Just it's because, especially with negotiating the deal, even with the most simplest deals, you can have complexities in any sort of area in the steps. Having a good team of advisors will at least take the stress level down a lot.
Yeah, and it always make you understand kind of the risks that are involved, the pros and cons, and what these things actually mean in reality. Audrey, we're going to come back to you. I think this is the last part of topic one, the legal roadmap, and we're going to talk about post-closing obligations.
Right. So as you mentioned, things aren't always completely settled on the day that we call the closing date. You generally have like a good sense of the company's value by the time the transaction closes, but you will have provisions in your purchase and sale agreement for a post-closing adjustment. So that's, for example, say your financial year end and your financial statements for the company being sold might be from a few months ago, and you're going to want to look at updated numbers to make sure that that what you're getting the day that you take over the company has that exact value that's current at that time. Well, that involves a provision for a post-closing adjustment where both parties will pay for an accountant to do some interim financial statements to look at the cash flows as of the actual closing date, and then they'll work out the balance that's owing or to be refunded based on the up to the minute financial information as of that closing date. So that's something you'll work out later. And then there's also security registrations. So like you mentioned, there can be situations where you're not going to pay the whole amount on the closing date. You're going to have a promissory note. It can be for a specific amount of money or for a percentage of future profits of that business for a certain period of time. And you're going to want to have what we would call security, or basically collateral, for that payment obligation. And so the seller is what we would call the security holder, the person that has a right to that collateral. You have to register that in a legal database called the security registry, so that other lenders can't come along and put their name ahead of his.
That's great. So for our audience, reminder, we're doing two topics today: the legal roadmap, and we're going to talk about the structure of the deal here in a second with Jacob. A reminder that in about, I'd say about 5 minutes or so, we're going to be coming to you, the audience, for questions. This is a unique opportunity. We're live with two experts, so please don't be shy. You can, whether you're on YouTube or LinkedIn, start entering some of your comments. We'll be coming to you in about 5 minutes. All right, Jacob, we're going to go talk about deal structure. So that was kind of the step by step by step. It's the legal roadmap, as we indicated. By the way, for our audience, we're going to send you these slides. So that was a lot to absorb. We'll send you the information. But now, Jacob, we need to talk a little bit about like what you're buying. So you're going to talk to us, Jacob, here about three deal structures that are typical.
Yeah, so in the mergers and acquisitions world, there's three different kinds of structures that people enter into. There are more in this, but these are the most general ones. The first one is an asset purchase, which is you agree to buy certain assets of the business, but you don't take the business as a whole. On the flip side, you have a share purchase where you're purchasing the shares of the business or corporation, where you're taking everything in the corporation and the seller just basically leaves with cash. Finally, there's an amalgamation, which is the continuation of two corporations into a new single entity. This can be different structures, such as creating a new entity or one entity absorbing another entity.
That's excellent. And we're going to go a little bit of a deep dive because there's some real complexity when you get into this stuff. So Audrey, you're going to help us kick things off, and we're going to do a little bit of a deeper dive into an asset purchase.
That's right. So as Jacob mentioned, the asset purchase is one where you're not taking ownership of the corporation itself. Like Jacob will describe share purchase. It's next, where you kind of just step into the shoes of the person driving the corporation. But the asset purchase is like, say the corporation's a car. Like a share purchase would be the driver driving the corporation changes, and the asset purchase would be all the stuff. You're selling all the stuff out of the trunk of the corporation. So that's like, for example, a corporation could own real estate. So you could be buying the real estate, all of the real estate of the corporation, all of the vehicles, machinery, all the inventory. It can be buying the intellectual property. So sometimes people will buy a corporation largely for the brand. That's very valuable because it means you know the quality you're getting as a customer. It can be something where you're buying all the contracts, so the supply agreements, the employment agreements. It's something that buyers often prefer because they get to pick and choose what they're getting. There's not as much risk that you're buying a corporation that's like, about to be stuck with a lawsuit, and that's your problem. It's more like you're just buying the stuff the corporation owns. But sellers, on the other hand, they don't necessarily want this because it doesn't have the same kinds of tax advantages that Jacob will get into. So it might be that buyers, in order to get this preferred structure, will offer a higher price than they would for a share purchase.
Yeah, when I've been involved in things like this or talked to other business owners, the asset purchase, as you said, is often about not taking on the liabilities of the corporation. So you want to buy the stuff. You said it very well. Like it could be a building, could be the brand, could be client list, could be intellectual property, but you're not buying the whole thing because the whole thing might have some liabilities that they don't want. But I got your point too, that the buyer might want that, the seller might be a little bit reluctant. So if it's not, Jacob, an asset purchase, it is sometimes a share purchase. So help us understand the distinction between those two things.
Yeah, so as Audrey was mentioning with the analogy of the car, basically is that you're with a share purchase, is you're buying the car and everything in it. With that comes along all the assets and the liabilities of the applicable corporation. The buyer buys the shares of the corporation, and therefore the buyer takes absolute control and full ownership of everything in it. This is often a preferred route for sellers of a corporation because, as I mentioned before, is they take the cash, they hand over the corporation to the buyer, they walk away with money and no other obligations attached to the corporation, subject to what might be in the purchase agreement. Sellers, on the other hand, also it's very advantages to them is that there's favorable personal tax treatment regarding share purchases, in the sense that the lifetime capital gains exemption is usually applicable to the share purchase. And accountants usually will push for sellers to move for a share purchase. On the other hand, when buyers are usually looking for an asset purchase, that's will go to the heart of negotiating the deal, where sometimes the buyer may seek a reduced purchase rate to factor in for the increased risk of exposure.
Yeah, some good points there. So we said it could be an asset purchase, it could be a share purchase. The other alternative, Audrey, is an amalgamation, like a merger of the two corporations. So tell us why that sometimes is the structure of a deal.
Yeah, so this would be the M in M&A. It's a merger as opposed to an acquisition. And it's when you have two corporations that are going to continue in existence as one single entity. And this can be, I mean, there's a lot of reasons this might make sense, but a major one is efficiency. So you don't need to have, like, if you have two separate corporations, that's two sets of tax filings every year, two sets of financial statements, corporate filings, like you're doubling up on everything. So if the two corporations are both rowing in the same direction, why not merge them together? And you don't need to duplicate the overhead. So that's very popular as long as they really are both rowing in the same direction. And diligence will be important in determining that, because the assets and also the liabilities of both of those separate corporations will continue to exist in the new combined entity.
I can completely see the rationale for merger for amalgamations and mergers. To me, it sounds really complicated. It's just like, oh my gosh, that one. I would always vote for the asset one, but I mean, I'm all.
If you were a buyer, you would.
Yeah, that's exactly it. Just buy those assets and leave some of the liability. So listen, we've got about 5 or so minutes left in the live show. So we're going to do a bit of a merger of talking about mergers of some questions and then some legal pitfalls. A reminder that when we're doing these shows, we're always like scratching the surface of things. And I think one thing that I'm always reminded of when we're talking to professionals is the value you bring to the table. But anyway, let's go to our first question, and it's from Jonathan Loshman. So I'll put him up on screen there. And he's asking, maybe Audrey, you could take a run at this, and Jacob, we can touch base with you too. What is your general perspective on a dual agency, or he's saying a business broker? So any opinions, probably not like legal opinions, but it's probably more of a value-based, or how can they play a role in the process? So we're probably looking for a little bit of advice here. Audrey, any comment on using a business broker to either buy or to sell?
Well, as you mentioned, going into these deals can be overwhelming for people who don't do them all the time. And so the more professionals that you can get advising you, who understand the marketplace, who understand the practical options that are actually out there, you're not just relying on the other party telling you, well, this is what my company's worth, or this is a great opportunity for you. You're looking at somebody who can be more objective because they're like doing this full time all the time, and they have the insight into the market that they can share with you.
And as always, it probably depends on who the broker is and their level of experience and expertise. But I get your general point. Having someone, I would imagine a business broker could be a little bit like an orchestra conductor in this process and help arrange all of the professionals, because there is a lot of coordination, let's say, that needs to happen. Jacob, any quick comments on a business broker?
Yeah, I would say is that sometimes it can be difficult for sellers or buyers to find the companies that they're looking for. And so they can play a good role in sort of finding the right buyer or finding the right seller, or at least exchanging the information between the two parties inherently to broker said deal.
Yeah, that's a good point.
Mm.
Our next question comes from Marcia Scott, and I'll put it on screen. I'll remind everyone that we've got two professionals that are seeing things like in a couple seconds and trying so I'm even trying to decipher this question. It's a good one, Marcia, but it's a specific one. So it's always hard to answer things that are specific. But Marcia Scott is asking, when selling an asset like a website, are there restrictions on what the seller can continue to do going forward post sale? So I'm selling, I think this is what Marcia is asking about. I'm the seller. I have a website. I'm selling it to someone. Am I restricted in what I'm doing after the sale? Audrey, maybe you want to take a first run at
Sure.
this.
Yeah, so absolutely. That's a very good question. And that is exactly the kind of thing we would address in the negotiation of your purchase and sale agreement. So you want to know, like, say if you're the buyer, and you're going to buy something because of, say, the value of the customer list or the value of the website, the brand, you want to know that the seller isn't just going to keep, taking that value out from under you, taking the customers away from you as soon as you've bought their business. And so this is one of those situations where non-competition agreements are enforceable. Now, a lot of people don't realize that because there are barriers to their enforceability in an employment contract, but not in this context of a M&A deal, because that is the value you're buying, right? Like if somebody's like, I'm going to sell you my business, they can't just go across the street and open the same business and take away the value from you. So those kinds of non-competition agreements, restrictions on trade, those are always enforceable in this type of context.
Okay, cool. Jacob, I'm going to give you the next one. The questions are coming in fast and furious now. And again, Jacob, appreciating that you're seeing this stuff for the first time. But I think Abby's asking something interesting. He says, so it's almost like a different deal structure. He's asking about a management buyout. So I am hearing more about this. So let's say, I've operated a business for 30 years. I can't find a seller. Often, sometimes the most likely seller will actually be the employees inside the company that know it back to front and are experts in running it. Any comments, Jacob, on employee buyouts?
Yeah, absolutely. So employment issues are very, very, very key components to M&A. Obviously, the larger the business, the more likely there's going to be bigger employees. Some advice I will generally give my clients in, say, from the buyer side is that there's a lot of value to retain key employees, because they're the people that they've been on the ground and they've been running the business, and you're going to want to continue with these people. So you ensure that even though you're going through a change of ownership, the business still runs smoothly and the general public doesn't get an indication that maybe there's been a change in ownership, or you can retain the value in the company pre and post closing. In terms of buyouts, sometimes it is an issue which people deal with in the transaction. Sometimes you see, such as in asset deals, there's usually an issue around termination of employees and rehiring, as you'll see businesses negotiate maybe a pool of funds which they use to deal with the termination issue of employees, just in case people don't flow through to the new business. So
Okay, good.
in short, it's a very, very, very complicated negotiating point in every sort of deal.
Okay.
There can be a lot of value there in that issue.
Yeah. Yeah. Listen, I'm going to give a shout out to Kay Whitfield. We're running short on time, but I think you just addressed a lot of what he's asking here, which is, often the value of a company is the people that work for it that have acquired that experience and expertise. And I think, as you indicated there, Jacob, that employment agreements and, maybe some sort of incentives for key employees to stay on for a certain period of time post merger, post acquisition can be important. Audrey, any quick point on that one?
I mean, it's also important to really think about whether the culture is a good fit, and to have a good transition plan, a good, change management plan, and have a plan to go in there and talk to those key employees, listen to them, see if they like the direction you're planning to take the business in, because you can't force people to stay if they're not happy.
You got it. Yeah, yeah. You can't. I mean, you're great lawyers, but you can't force them. We can't shackle them to their desk and
You
say,
can't do that.
"Sorry, you
That's
can't leave." Listen, we're gonna move into our wrap up period. We had planned for two pitfalls. We were gonna talk people, but I think we talked about people quite a bit in the last few minutes. So the one thing maybe we'll wrap up with, and it's always the pitfall that's on my mind. This is the pitfall to avoid, not a pitfall to fall into. Is money, right? Like at the end of the day, a lot of this is being done. Let's speak plainly here, for money. So, the seller wants to maximize, the buyer wants to minimize. So, Audrey, maybe your quick take on that. So, I think even if you've got a great team of professionals, lawyers, accountants, valuation experts, maybe even a broker, at some point this is going to come down to money. And I know that's not like a legal. It is part of the legal process. It isn't like in law. But what's your quick take? And then Jacob, I'll get you to talk about how to avoid a dispute over valuation, I guess is what I'm saying.
Yeah, so you can have dispute resolution provisions in the agreement of purchase and sale. And that can even set out a process like that. Say when you're looking at those post-closing adjustment inputs, you will agree in advance while you're still getting along on what process you'll follow to resolve a difference. And that can look like a specific accountant, or a process for appointing an independent accountant to weigh in on that dispute. So that you're not just like taking each other to court right away, but you're looking at how to solve that difference.
I like that advice. Like get ahead of this. That idea of almost like a mediator. Anyway, Jacob, I'll go to you. Then we'll continue with our wrap up. Like any thoughts on how to avoid, or maybe the other way of putting it, more positive, how to come to an agreement on valuation. Any legal thoughts on that?
But I'd say just along the same lines as Audrey is that having a team of professional advisors is always prudent, and you want to make sure is that you have ironclad agreements surrounding dispute resolution and sort of price adjustment clauses, just so the less surprises are, the less problems there likely will be in the end.
Yeah, good advice. All right. I always want to emphasize that when we're talking about mergers and acquisitions, Audrey, you mentioned it much earlier, that this is something, and I'm thinking as the seller, that you just can't switch into this mode. It is massively important to determine where your business is going and start taking those steps. Often it's putting paperwork in place to lead up to it. So we're going to bring your contact information on screen here, because I think if you're watching this and you're a business owner and you're thinking, whether it's in 2 years, 3 years, 5 years, you're going to sell, what the good advice is? Talk to Nelligan now and start getting that stuff started. Right, Audrey? Is that prudent advice?
Absolutely. You want your business to be in good shape before you start looking at selling it.
Yeah, and it's gonna solve everyone time and money and frustration if you do that. So on screen here, you can see Audrey's full contact information, Jacob as well. Listen, we have run to the end of the clock here on this live broadcast. Audrey and Jacob, I want to really thank you. You've done a great job. This is there's a lot of complexity around this, and it's not something typically that business owners are dealing with like on a day-to-day basis or year-to-year basis. So I think it's really important what we've done here today. We provided that roadmap and deal structure and a little bit of Q&A there. So thank you very much, Audrey. Thank you, Jacob, for being part of today's show. Really appreciate your involvement.
Thanks for having us, Michael.
Okay.
Yeah.
A reminder for everyone that registered, and that's a reason to register, by the way. If you register for these, guess what you get? You get the replay link and you get the deck. And you also get the easy to access contact information for our experts, in this case, Audrey and Jacob. So also a reminder for our audience that you should be visiting obj.ca website every day for the latest and local business news. I highly recommend you subscribe to OBJ Today, which is our weekday email newsletter. Quite literally, thousands and thousands of local business leaders rely on that newsletter on a weekday basis to understand what's happening in our city. I know you're thinking, what the heck do I want another email for? It arrives in a summary format. I promise you, you can scan it in about 30 seconds. You can also follow us on social media. Our LinkedIn is almost at 40,000 followers, which is really exciting for us at OBJ. And finally, if you're on YouTube, please click the red subscribe button and the little bell icon. If you do that, you'll be notified about future live broadcasts. That brings us to the end of the show. On behalf of Nelligan Law and OBJ, I want to thank you for participating. Keep on trucking Ottawa. Let's build a stronger community. Thanks, everyone. See you soon. Bye-bye.